So, we know about the 2007 to 2008 financial crisis, and that asymmetric information was a contributor to the problems. But exactly what were the problems?
Just a minute. There are different types of asymmetric information. For now, let's talk about issues in the crisis that involved a type of asymmetric information called adverse selection.
I've heard of that. Didn't something happen with liar's loans, subprime markets, and banks?
Yes, but you're confused, because more than one example of adverse selection took place before and throughout the financial crisis. Just let me explain. Between February 2007 and January 2008, 5 major mortgage or home loan companies filed for bankruptcy. And multiple other similar companies borrowed money or merged with other companies. Many of the smaller mortgage or home loan firms go through bankruptcy and mergers before the crap really hit the fan. Yes, this took place around the time of the burst of the housing bubble, but it was the types of loans and episodes of asymmetric information that added to the overall depth of the crisis.
A lot of the loans or mortgages were subprime, which meant these borrowers wouldn't usually qualify for a normal loan because of a low credit score, no job, or something along that line. They were riskier loans for the lender.
Yes, and at the time that lenders were accepting these types of borrowers, the mortgage rates were low and the US economy going strong. It seemed like an ideal time to ease up on lending standards and take on the riskier borrowers. However, once the financial crisis began, the lending standards tightened up.
The lenders accepting the loans knew what they were getting, risky borrowers who might not be able to pay them back. And that's why the companies went bankrupt, right? Because the lending standards were low to that point, banks took on too many subprime borrowers, and then the subprime borrowers couldn't pay when the economy took a turn for the worst.
Sort of. The low lending standards were already being tightened up, and yes, many of the subprime borrowers could not pay. However, asymmetric information comes into play in the form of adverse selection before the crisis really hit, specifically in the form of a liar's loan. These types of loans are lent when the borrower has a hard time proving income or asset verifying documents. The term liars is added when borrowers, mortgage brokers, or loan officers overstate the income and/or assets, so that the borrower is qualified for a larger mortgage. In other words, the lender knows the loan isn't a good one, but plans on packaging and reselling the worst ones to other investors.
That's still a risky loan for the lender and especially the investor. There has to be an incentive for the lender somewhere, right?
You're getting there. See, subprime loans are high risk for everyone involved, especially the lender. What was happening before the financial crisis was that a lie was being added to subprime loans, making the loan look like a prime loan, which was less risk and more profit for the lenders. On an outward glance, it looks like a safe, low-risk loan. Of course, the loans really weren't prime, which is why they were liar's loans. And then another level of adverse selection raised its head as the lenders resold the worst of the liar's loans to investors worldwide.
But the lenders did not care, because if the loans were considered prime, they made more money or profit. Which, of course, was their incentive for accepting the high-risk loans and making the loans seem better than they were. But hey, there has to be laws against it or some type of regulation, right?
If laws and regulations worked, both superheroes and superzeroes would be out of jobs. But you are right. This is where we need to mention failure of risk management and securitization. It will help us to wrap up this example of adverse selection. The overall purpose of risk management, or RM, is to minimize or decrease the chance of bankruptcy. The issue that takes place up to the financial crises is the lack of incentive for large banking or mortgage firms to worry about the risk of low probability events.
Instead, they were worried about where they could make money. And that was by taking on more liar's loans and keeping a secret the fact that the portfolios and information on the loan was not as great as it seemed.
That's right. Risk managers who evaluated the risk of loans and accounts were around, but they were incentivized to overlook the high risk of some, or in the case of the financial crisis, the majority of the loans. At the time, it did not seem like a problem would come from the loans,
which could also be considered principal agent because the big heads at the top were making bank.
Yes, and we will get to that. In this case, we're talking about the adverse selection, which was when loan originators used their informational advantage of the loans being liar's loans, and sold to investors before the loans turned bad. The loan originators got the money and the investors had to make lemonade with their supposedly low-risk loans turned bad.
Back to risk management. Certain people and firms were making a lot of money, but the risk of the loans and investments they were making was so underestimated that it ended in the company having to be bailed out, borrow money, or file for bankruptcy. But not exactly in that order.
Yep, and a quick side note. At the time of the financial crisis, many of the risk models used were untested, and it wasn't figured out until too late in the crisis to do anything. In a publication by William W. Lang, a chief examination officer at the Federal Reserve Bank of Philadelphia, many risk models did not have the historical data that accounted for times of periodic distress, or the models didn't account for changes in asymmetric information.
So, what you are saying is that issues with risk management models contributed to many firms getting away with the liar's loans as long as they did.
Yes, as we talked about earlier, there are multiple factors that contributed to the financial crisis of 2008. Examples of adverse selection were present before, during, and after the crisis. As we talked about here, it was often in the form of making a subprime loan look like a prime loan by hiding pertinent information. Some sides of the deal got rich, but a lot of firms got caught too.
Ha! Like Merrill Lynch.
Oh, let's take a break, and then we'll talk about that. Any questions from you?